Thanks for tuning in with us today to talk about the upcoming and some have already happened tax changes. I'm Rox Carlsen, so I'm a financial advisor here at Rival Wealth, and I'm with Simon Moor, who's a chartered accountant and owner of Rival Accounting. There'll be an opportunity at the end of this to answer questions. So if you think of anything as we talk through the slides, then please type your questions in and we can talk about them at the end of the presentation. Simon's probably going to do most of the talking because it's more his scope of expertise. So Simon, I'm going to pass that over to you. Start talking about the tax.
Thanks very much, Rox, and welcome everyone for coming along today. We are just going to talk about the tax changes, as Rox mentioned, not the individual rules. We're talking about bright line tax, interest deductibility. There's a lot of rules around those. We're just talking about the main changes. So the first change we're going to talk about is what the ID call the marketplace rules. Everyone refers to them as the app tax, so that's what we're going to do. That came into effect, these changes, from 1 April 2024. And essentially, if you conduct business with an app, the main ones being is on the screen there, Airbnb, Book a Batch, Uber Eats. If you conduct business with them, then any income generated from those apps is now going to have GST on it. And importantly to note, it's actually going to be the app, so Airbnb, Book a Batch, etc., that are going to actually pay the GST to the IRD, not the individual providers such as the Uber driver or the owner of the property.
So it's going to go direct from the app holder. That's what you're saying?
Correct. Yeah, the
app's going to IRD.
Yeah, so the IRD be in contact with all the apps, and they've got systems set up in place. They've been trained how to apply all the rules. But what it means essentially, it depends whether you're GST registered already or whether you're not. If you're not GST registered, then there is going to be GST essentially on the income when you rent your house out through an Airbnb platform. Now, that doesn't mean you have to actually register for GST. It just means that the app's going to collect GST on that and they'll pass it on to the ID. Now, because if you're not GST registered, you're not able to claim any of your current costs associated with it, for example, rates, insurance, repairs and maintenance on the property. So for that reason, the ID have allowed what's called a flat rate tax credit of 8.5%. This is just for non-GST registered providers. And what that means is, let's say you rent out the house for $115, nice round number, obviously you probably rented out for more than that. But essentially what happens there, if you're non-GST registered, is the guest pays $115 to Airbnb. And I'm going to ignore the cleaning fees and the host payment for this example. And then in that situation, the Airbnb will pay you back $100 straight to you as your share, your GST exclusive share of the rent. They're also going to pay you 8.5%, in this example, $8.50, which is a flat rate tax credit. That is exempt from income tax, and essentially it's acknowledging the fact that you are incurring costs such as rates and insurance, and you can't claim them back for GST purposes. So, and then they're going to pay $6.50 or 6.5% onto the ID as GST. So the main thing to note there is that the app provider is going to make it really clear, or they're supposed to make it really clear, how much the flat rate tax credit is, and you don't need to include that as income in your income tax return. And importantly, you personally are not actually paying the GST. The app's taking care of that for you.
So the app providers will have some sort of reporting or something for you? Do you?
Should do. Haven't seen them yet, but the idea have been in communication for quite a while with these app providers, and they've all had to essentially get assessed to make sure they comply with the rules. So haven't seen an Airbnb report yet, but I'm sure we'll see one soon.
Yes.
And the other thing is, if you're already GST registered, you've already been returning GST to the IRD. So the example I gave again of $115 for a night's accommodation, what you'd currently be doing is you'd get $115 back by Airbnb, and you return $15 of that to the IRD for GST. That has changed from 1 April. So essentially you need to treat that as a GST zero rated supply. And essentially that means you don't pay GST. So in the example, $115 that the guest pays to Airbnb, Airbnb will pay you back $100, being the GST exclusive portion. And the app will provide the $15 onto the ID for GST. And you treat that as a zero rated supply. So essentially you don't pay any further GST on that. Really important that you do that. Otherwise, if you put that through as $100 of GST income, you're essentially paying GST twice, and no one likes paying GST once, let alone twice. So make sure you do that. And there's been quite a few, I guess, misinformations or mistruths circulating, particularly around the app tax. People saying, well, if I rent my property to Airbnb, then I'm going to have to register for GST, or even worse, I'm automatically registered for GST. That's simply not the case. And importantly, again, as at the start I mentioned, it's the app paying the GST onto the ID, not you paying it on. Now, that leads into another, I guess, thing I want to touch on is you can choose to register for GST if you want, but there are some fish hooks in doing so. The main one being that if you're currently not GST registered, let's say you've got a house, the Airbnb that you bought maybe 10 years ago for, we'll call it $600,000 before the big property boom. If you register for GST now, then you can claim GST back on the $600,000, which is quite a nice little cash boost. However, and this is the big however, is that when you either sell the property, there's GST on the sale of the property, and presumably you're going to sell it for more than the $600,000 you bought it for. But equally, if you stop providing GST services, exactly, you stop renting the property out, then you'd need to pay back GST to the IRD on the market value of the property. So again, if you've owned the property for 10 years, there's a very good chance it's gone up in value. You'll end up paying GST back on the market value. So I'd always recommend talking to your advisor before you want to start registering for GST. If you're in the Airbnb or Book a Batch game, because it can be pretty, can hurt a lot if you get a big tax bill, essentially. So
Simon, just to clarify too, the GST threshold for registration is 60,000 or something.
Still 60,000. Yeah. So essentially, as long as you're doing less than 60,000 turnover, not profit, per year, then less than that, you don't have to register for GST. More than that, you do have to register for GST. So in some cases, if you're hovering around that kind of 55 to 65, you probably want to keep it under 60 just to avoid having to be deemed to register for GST, mainly because of that fish hook I talked about. But equally, if you're going to look to register for GST, have a chat with your accountant first.
Good idea. Good idea.
Okay, well, the next tax change is the trust tax rate. Now, there's been a lot of news around this. Initially, they were just going to make it a flat 39% increase from 1 April. And that is mainly the rule from 1 April. So essentially from a few days ago, the trust tax rate has gone up to 39%. However, if you have less than $10,000 of income left in the trust, the tax rate remains at 33%. And it can actually include, it's only trust income left over. So if you have, say, $50,000 of trust income and you distribute, say, $45,000 to a beneficiary, because only $5,000 has been left over, the trust tax rate is 33%, not 39%. A lot of estates get turned into trusts when someone passes away. And so for that reason, in the year of death and 3 years subsequently, the tax rate on estates is just 33%. It does revert to 39% after the 3 years, provided you've got more than 10,000.
Even though it's listed as a trust or in a trust entity.
Yeah, you have to prove it's an estate, but usually the trust would say estate of X, XYZ. So yeah.
Okay.
Now, with the increase to 39%, you can imagine there's even more, I guess, people wanting to distribute income to avoid paying that, to beneficiaries to avoid paying the 39%. So the IRD have initiated a range of anti-avoidance rules. And essentially, there's a number of rules involved in it, but ultimately, if you're going to distribute income to a beneficiary, that beneficiary needs to actually receive that income. So if you're going to say husband and wife and the husband lends his income, so you're going to allocate 40,000 to them, the money would actually need to be taken out of the trust to show that it is really a distribution to them. And then that income distribution will be taxed at the individual's marginal tax rate. Which, unless they're earning more than $180,000, is going to be less than the 39% tax rate. So, yeah. Which really, and this is probably more your area, Rox, it does sort of lend itself to noting that if you invest in a pie investment, then the trust tax rate's at 28%. So maybe you could just...
Yeah, so it will be quite important for trusts that do have investments to have a look at them or seek advice, particularly from a financial advisor or their financial advisor. about what type of investment they're in, because essentially you could save 11% on your tax if you've got your investment in a pie fund rather than just individual investments. So that's where someone like myself comes into play, as far as and work alongside your accountant with questions on the tax side of things. That's how that sort of works.
Yeah, that makes a lot of sense. I think it's all about making sure that you have got the most tax efficiency, but also you're getting the best return on your investment. So that's where I guess the two-pronged accountant and a financial advisor can come in very handy.
Yes, definitely.
Yeah. Okay, well, the next change we're talking about, and this has been very hotly debated in the news, is the new interest deductibility rules for rental properties. As most of you are probably aware, if you've got what's classified as a new build, then you've been able to claim 100% of the interest back. So pretty much essentially no change from what investment rules have always been about. However, more recently, there's been limitations on interest deductibility if you've got a property that's not a new build. So for example, the year that's just finished, interest deductibility was at 50%, and the year before that is at 75%. Whereas there are some changes coming in. There had been some talk earlier that the year is finished, so the 2024 year is just finished. There'd be some changes there. The government have confirmed there's no changes. That stays exactly as it is. It's 50% tax deductible for a non-new build. However, for the year we're just started now, the 2025 year, the threshold's going up to 80% interest deductibility. And for the 2026 year, it's going up to 100%. So again, a full interest deduction back for the 2026 year. And probably the biggest thing that perhaps we haven't talked about is that if you bought a property after the 27th of March 2021 and it wasn't classified as a new build, or if you've taken out any additional lending for a property that was purchased after 27th of March 2021, then you got 0% interest deductibility, which is actually quite a big deal. We saw plenty of situations where that happened, where you could be making a cash flow loss, as in the rental income's less than your costs, but because the interest wasn't being counted, then you ended up having to pay tax. A bit of a, no one likes paying tax, but it was pretty harsh. The good news is that from the 2025 year, which we're in now, you can start to claim interest back again. So for the 25 year, it's going to be 80%, and it goes up to 100% for the 2026 year. So that's a big change, because for this year, it's an 80% swing for people in that boat.
Yeah, that's great. That's great.
Yeah.
Is it sort of time to look at structuring your debt within your portfolios now?
That's a really good question, Rox. With the reduction to 0% essentially of any new lending taken out after 27th of March, it meant that if you were to, say, transfer a property from your own name into a company, which you used to be able to do, and then borrow the market value of the property in the company, you'd instantly get a 0% interest deduction, because essentially it's a new property purchase. It's not a new build after 27th of March 2021. So it pretty much ruled out a lot of restructuring. That does now get back on the table. So you can do that. You'll get an 80% interest deduction for it. So I know a lot of our clients have been holding back, not making any changes until these new rules got announced. It is important to note, though, that that's on the interest deductibility side of things, but there are other income tax considerations, such as bright line tax and other subdivision rules. We'll get into bright line tax in a minute, but it's important to note that there could be some other things to consider on, for example, bright line not having to pay capital gains tax if you sell a property to another entity. Another thing just to note, just before we finish on this topic, there had been talk about if you'd been only claimed 50% interest last year and 75% the year before, whether there'd be some sort of wash up where all the interest that you weren't able to claim previously can get claimed back. And the answer is no. They've been very firm that if you didn't claim it in those years, you can't claim it. I guess it's probably too good to be true.
We can't. We've got one thing, so we've got to go with that.
The only exception being if you trigger the bright line rules or any other property tax, you were able to, as was always the case, able to claim that interest back, only to assess whether you've made an overall profit on the bright line tax rules, or if you're a property developer. So.
So is it, this is going to obviously have an effect on our bright line rules, is it? deductibility?
I think it's going to make it a lot more attractive
Yeah.
for property, for get back into residential property.
Yeah.
I know a lot of our clients had held off, whether they're going to buy another property, whether they sell a property, depending on the election result. Just because if it wasn't for this change, then this year would be down at 25%, and then the following year would be at 0%. So that makes it very difficult to to justify the financial business case on owning rental properties. So a lot of property investors will be very happy about
that.
these things.
Similar to clients I was speaking to as too regarding investments and whether they went down the property way or portfolio was a lot to do with that. So good one there.
Yeah.
Yeah.
Okay, well, moving on. The next rule change we're talking about is the bright line rules. And so the good news for property investors again is that the rules are going to revert to 2 years. Bright line window from 1 July. Currently, it's 10 years if you've got an existing property and 5 years if you own a new build. So this is quite a big change. And it brings it back into line of when the first bright line tax was brought in place many years ago, it was just the 2 years. Now, it's important, like most things, there is the devil's in the detail. And so when working out whether you've triggered the bright line rules or not, it's based on the settlement date for when you purchase a property, but it's based on the unconditional date for sale. So once you trigger or meet all the clauses like your due diligence, even if you don't settle until later, it's actually based on the unconditional date for sale. So just an example to talk through, let's say you purchase a property on the 31st of August, 2022. That's the date you settled it. So that counts as the purchase date. If you then, in say 15th of July 2024, went unconditional on the sale, because the date between the settlement and the unconditional date is less than 2 years, you will trigger the bright line rules. However, even if you settled the property, say in 15th of August 2024, even though that's longer than a 2 year, 15th of September 2024, that's longer than a 2 year period. It's the unconditional date that actually counts. So it's really, I guess, the fine print. You want to make sure you've talked to your advisor, because if you think you're going to avoid bright line tax rules, the idea do get details of when any property transacts, so they know when you've bought and sold a property. So just make sure you've talked to your advisor to ensure you're not going to be hit by the bright line rules. But certainly very good for property investors. It allows you to perhaps sell an underperforming property when you might have had to hold on to it before. Pretty complex, aren't they? All these property taxes and things that go along with. I mean, they're a big tax taken. So it's becoming more and more common. And I have to say the ID systems are getting a lot better at tracking purchase and sale information, which again makes sense. But they've got a lot of visibility in when properties are being transacted. Another change is around the main home exclusion. So most of you would be aware that if you use a property as your main home, then you wouldn't actually end up having to pay bright line tax on it. You can get exempted out of that. The rules changed on the main home exemption recently, whereby if you've owned a property, say for 4 years and you've used it 1 year as your main home and 3 years as a rental property, then the proportion of time used not as your main home would be taxable. So in that example, if you made 100,000 bright line profit, you'd only pay 75% of that. It will be counted towards the bright line rules because 25% you're using it as your main home. They're now going to revert back from 1 July back to what they were initially, which is where if you use the property as your main home for more than 50% of the time you owned it in that 2 year window, then you won't pay any bright line tax. If you use it for less than 50%, then you pay the whole thing for bright line tax. Oh, so it's just one or the other. It's one or the other. That's how it used to be. And it makes sense now that they've shifted the window back to 2 years. When it was 10 years, you can understand it's being prorated. Your prorated made more sense. And I did touch on it before, but I will bring it up again. Bright line tax is just one type of property tax. There's a whole bunch of other provisions in the Income Tax Act. For example, if you're a property developer, if you subdivide properties, if you buy a property with the intention of sale, all of those things are going to be taxable. They're not bright line tax, but they're definitely tax associated with properties. So it's important you, again, talk to an advisor if you're looking to sell a property. It's not just bright line tax to consider. No, that's going to come into play. Okay. The next rule is commercial property depreciation. So from 1 April 2024, depreciation is no longer claimable on commercial properties. The ID brought it back into being claimable as a COVID measure, and they've now determined that COVID is no longer effective for income tax, and therefore they've removed the ability to claim depreciation on commercial buildings. With residential building, that's still 0%. It always has been for some time, and that hasn't changed. It's just the commercial side of it.
So do commercial properties depreciate?
Well, they don't usually, Rox, and I'm not a property valuer, but from what I see, that they often don't. I mean, it was more just really, I guess, a cash flow advantage for a commercial property owner. Let's say you bought a property for $1 million. In most cases, if you hang on to it for more than at least 2 or 3 years, it's going to go up in value. But what it meant is that if you were claiming depreciation, it was less tax to pay during the years you owned the property, so that was good for cash flow. And almost invariably, you'd have to repay the depreciation as depreciation recovered when you sold the property, but then you had the money coming in from the property sale, so therefore you had the money to pay back that depreciation recovered. So it was definitely a good cash flow thing for a commercial property owner. So I know a lot of commercial property owners are disappointed about the change, but that's an effect from.
And it was probably how it used to be anyway. But
it's kind of gone back and forth a few times. So it is unfortunately for commercial property owners, they don't get the cash flow advantage of that. But that's an effect from 1 April 24. And the last one we want to talk about, I'm sure everyone's heard about it, is tax cuts. It was a campaign promise for the government that's now been elected. I wish I had news about, just how they're going to look at the stage. It's still yet to be confirmed. Latest talk from the government is that they're still going to get put in place. As to what level, they haven't confirmed that. And they're supposed to take effect from 1 July 2024. And I've just listed there what the planned thresholds are going to be. Essentially, what's happened is there's been an inflation adjustment to the income tax bands. So, for example, the 10.5% tax rate would go from 0 to 15,600, and the rest, as you can see down there. You can see that the 39% one has not been changed. So, essentially, anything over 180,000 you'll still get taxed at 39%.
So these tax rates, just to clarify, are progressive. So
that's right. That's right, Rox.
Flat,
so progressive, So progressive means if you had, say, $50,000 of income, then your first 15,600 will be taxed at 10.5%. And then from 15,600 up to 50,000 will be taxed at 17.5%. So you're essentially getting a blended rate, which is different to, say, a company or a trust, where the company's got a flat tax rate of 28%. And a trust flat tax rate of 39% or 33%, depending on what we said earlier in the seminar. So so that brings us to the end, and we do have time for a question. So if you've got any questions, please type them in the Q&A section. We've got a couple coming in already, which is good.
I've just got one before you move on to that, though, and it goes back to that tax rate for the trust. So you talked about $10,000 being left in the trust. Is that net of costs? So that's all expenses gone out.
That's right. So if you had, say, $20,000 of income and you had $11,000 of costs, and you've only got $9,000 net income, so that would be taxed at 33%, not 39%. Oh, got another question coming in now, it looks like. Okay, and so I've asked, what's your advice if I've got an Airbnb? Doesn't say whether they're GST registered or GST non-registered. I'm going to answer for both. Essentially, if you're GST registered, there's not really a big change for you, as in you're always accounting for GST on your income from Airbnb. So really, nothing's changed except for the fact that you've got to change how you account for it in your GST return, so that it becomes zero rated income. If you're not GST registered, then, as we mentioned before, the app's going to return GST on that income, and they're going to pay you that 8.5%, but it means you're out of pocket essentially by 6.5%. So that's possibly not a reason to pull out of putting your property in Airbnb, but realistically speaking, unless you increase your prices by 6.5%, you're going to be making less income from it. And so my advice there would be, perhaps have a think about, if you increase it by 6.5%, whether that's going to make your property attractive on the Airbnb platform. I have heard that there's been a few properties pulling out, which means there's less supply of those properties, which does push the prices up. Also, if you're non-GST registered, I certainly would not recommend rushing out and becoming GST registered. And the reason for that is essentially those fish hooks. And in my experience, it's never worth it, because if you've owned a property for a while, the price has probably gone up. And you might get, be able to claim the GST back on your cost for 1 or 2 years while you were Airbnb the property. But when you eventually stop Airbnb it, the big GST to pay back is, it's often a bit scary. So, yeah. Got another question coming, actually a few questions coming. So the first question is the GST taken off the nightly rate after Airbnb have taken their fee? Yes, well it is, but there is also GST on the Airbnb fee. So essentially, I guess you're getting hit with both, but you're going to have to pay GST on the Airbnb fee as well as the nightly rate. Next question. Please display the text page again for notes, more a request than a question, but that's okay.
Well, we're sending out a recording to any of this,
Yeah.
so you'll have
Yep.
you'll be
Yep.
able to select that page
Yeah.
yourself anyway.
So just put it on there now. I mean, essentially these are the proposed rates that's absolutely subject to change. I believe there's actually online you can go to a tool that works out how much you'd save. The tax calculator. I'm not going to post the link, but just again a reminder, these are provisional, they're not the final ones. The next question we've got is what is the average savings we're talking about for an average salary person? Maybe a tax calculator available online for comparison. Yes, there is. I've actually answered that question before I read it. I think they're ranging from sort of in between $20 to $200, depending on how much income was earned. There's also some factors such as the new childcare subsidy, which we haven't talked about. We don't advise on that. So my recommendation would be to look into the tax saving calculator, which you can get online, which National published. But again, just being mindful that these are provisional amounts, so I wouldn't go ahead and spend that tax saving because at the stage they're not actually put into play.
Confirmed, yeah.
Yeah.
And just a reminder too that all the information that we've provided today is just general of a general nature. That you can contact myself or Simon if you have specific questions regarding tax, obviously to go to Simon. If you want to discuss investments or things like that, then certainly come to myself as a financial advisor. So we do work hand in hand, don't we?
Yeah, absolutely. And these are contact details there. It's a good little segue into that. There are contact details there. I mean, we are going to send out a recording of the webinar as you did, Rox, so our details are on there. But please don't hesitate to get in contact, mainly because when it comes to most of these taxes, it's very much case specific. We can't answer any specific questions generically, but more than happy to answer them, offline. Yeah. Just maybe leave another minute for any more questions. We're just about at the end of the 30-minute time slot, and probably answer the next couple of questions if any come in.
Maybe we explain things very
maybe we
clearly.
did. That could very well be it. Yeah. Or there's too much tax talk and it's doing everyone's head in. So
that's great.
So we've got a couple of nice comments. Thank you. Appreciate that. And we've got a raised hand. So we can't actually, if you could maybe just type in your question rather than raising your hand, that would be good. Okay. That's probably going to bring us to the end of the webinar. Appreciate you for tuning in. As I mentioned, we will send out a link. So thanks for your time today, Rox.
Yeah, and if anyone has, like we say, any questions, then feel free to contact us. We can help you with them.
Yeah, looking forward to it.
Yeah.
Thanks very much.
Okay.
Okay. Thank you.